Hey everyone, I hope you guys are doing good. So today is Monday, May 18th, and I want to get straight into it because there is genuinely a lot happening with SoFi right now, and I think most of it is not being talked about clearly. The stock is sitting at 1561 today. The 52-week range is 1274 on the low end and 3273 on the high end. So right now we're hovering about 14% above the 52-week low and about 52% below the 52-week high. For those of you who are still holding, I know that's not a fun place to be. And I know a lot of you have been asking me what's going on and what comes next. So let me walk you through everything I see right now, piece by piece. Let me start with what actually happened with earnings, because I think the reaction the market had tells you more about sentiment than it tells you about the business. On April 29th, SoFi reported Q1 2026. Revenue came in at 1.1 billion, up 41% year over year, beating estimates by nearly 5%. EBITDA was 340 million, up 62% year over year at a 31% margin. Net income was 167 million, that's 2.3 times higher than the same quarter last year. They added over 1.1 million new members in Q1, which is a company record. Loan originations hit 12.2 billion, also a record. And this was their 18th consecutive quarter of beating the rule of 40, this time with a score of 72. To put that in perspective, a score above 40 is considered excellent. 72 puts them in elite territory. So why did the stock fall 15% on earnings day? Two reasons. First, management maintained their full-year guidance rather than raising it after a strong Q1. The market had priced in a raise and didn't get one. Second, and this is the one that really hurt sentiment, the technology platform segment was down 27% year over year. That's the Galileo and Technisys business that powers other banks and fintechs. They lost a large client, and that one departure dragged the whole segment down. The market fixated on that and punished the entire stock for it. Now here's what I personally think about that. They added 13 new partners in Q1 that weren't generating revenue in Q1 of last year. New partnerships don't generate full revenue on day one, they ramp over time. And management confirmed that a major partner integration is completing this summer that will start adding recurring revenue. I'm not dismissing the technology platform weakness, but I think the market is treating a one client departure as a permanent structural problem when the evidence actually suggests it's a temporary disruption inside a segment that's still growing its partner base. Now I have to address something that every SoFi investor needs to understand clearly right now, and that's the Muddy Waters short report. Back in March, Muddy Waters published a report claiming SoFi was doing some aggressive accounting. Specifically, they alleged a $312 million loan package wasn't actually sold the way SoFi reported it, that the student loan portfolio is being overvalued, and that EBITDA is being inflated. A law firm then opened a securities fraud investigation, headlines everywhere, stock down again. And now Morgan Stanley analyst Jeffrey Adelson just cut his price target to $16 with an underweight rating, citing higher marketing costs, increased investments, and weaker expectations for the technology platform. I want to be straight with you. I don't dismiss Muddy Waters as noise. They have a real track record. I read the report seriously. But here's what I keep coming back to. This is a potential securities violation, not an actual one. And the market right now is pricing it like it's already been confirmed. That gap is where I think the mispricing sits. Think about what happened with Facebook a few years ago. Mark Zuckerberg was literally sitting in court while the stock was getting hammered. And then the next earnings call came out strong, and the market essentially forgot the legal situation ever happened. The share price took off like a rocket. The market has amnesia when the fundamentals confirm the story is intact. I went through the Q1 10Q filing this weekend looking for red flags, and what I found actually made me more comfortable. Crypto gross revenue was 121.6 million, but crypto costs were $120.7 million. Net crypto revenue was 852,000. Essentially break even. A company trying to inflate earnings doesn't voluntarily show you that a $121 million revenue line nets to less than $1 million. That's full transparency in a place that doesn't look great. And that's actually what I want to see from management. And so far there has been zero formal regulatory action, zero SEC subpoena. Every quiet week that passes is 1 week closer to this story fading. Now, let me talk about something that I think is genuinely underappreciated right now and could be one of the biggest tailwinds SoFi has seen in years. Trump's tax legislation is moving through Congress right now, and it includes major cuts to federal student loan programs. Graduate students would be capped at $2,500 per year in federal borrowing with a $100,000 lifetime limit, down from the current $138,500. Professional students, so law school, medical school, MBA programs, would be capped at $50,000 annually and $200,000 total, down from $224,000. Parents would be capped at $65,000 total through PLUS loans. The bill has already passed the Senate and is heading to the House. If this becomes law, and right now it looks increasingly likely, there is going to be a massive funding gap for students that the federal system simply cannot fill anymore. And who fills that gap? Private lenders. SoFi has already disclosed in letters to Congress that they are preparing for a surge in demand. CEO Anthony Noto said on the April earnings call that if the federal government limits student lending, SoFi would absolutely capture that opportunity. SoFi started as a student loan refinancing company. They have more brand recognition and market share in student lending than almost anyone else in the private market. If federal loan access shrinks by tens of billions of dollars annually, the demand that flows to SoFi could be transformational. I am not modeling this aggressively yet because the bill hasn't become law, but this is the kind of structural catalyst that doesn't show up in the current stock price at all, and I think it's one of the most important things to watch over the next 30 to 60 days. Now let me address the OpenAI question because I keep seeing this come up and I think it deserves an honest answer. The headline that went around last week was essentially asking whether OpenAI is adding more competitive pressure to SoFi. OpenAI released a new model with financial services tools built in. The concern being raised is that AI-powered finance tools could eat into what SoFi does. I want to be direct about this. I think this is a real long-term consideration for any fintech, not just SoFi. But I also think the nature of what SoFi does is fundamentally different from what an AI assistant can do. OpenAI can help you analyze a portfolio or answer financial questions. It cannot originate a loan, hold deposits under FDIC insurance, issue a stablecoin from a nationally chartered bank, process $12 billion in loan originations quarterly, or run a payment processing infrastructure for hundreds of banking partners. SoFi has a bank charter. That is a regulatory asset that took years to obtain and gives them structural advantages that an AI model simply cannot replicate. And frankly, SoFi is already using AI themselves. AI-driven fraud detection, AI-powered personal finance coaching tools, AI in their underwriting models. This is not a company that's a sitting duck for AI disruption. This is a company that's integrating AI into the platform they already built. I don't think the OpenAI headline is a reason to sell SoFi. I think it's a reason to watch how management responds, and so far the response has been to use it, not fight it. Let me tell you what the analysts are saying right now because I want to give you the full picture, not just the bull case. Truist just cut their price target to $17 from $20, keeping a hold rating, citing loan platform slowdown pressures. TD Cowen lowered to 18 from 24, also hold. Deutsche Bank cut to 18 from 26. Morgan Stanley is at 16 with an underweight. These are not small cuts. The average 12-month price target across 17 analysts right now sits at approximately 21 to 22. That still implies 35 to 40% upside from where we're trading. And on the bull side, Mizuho kept their outperform rating and still has a $29 target. The setup is that the bears are clustered around $16 to $18 and the bulls are pushing $29 to $31. The question you need to answer for yourself is which camp has a better read on where this business is going. And here's the signal that personally gives me the most confidence in the bull case. CEO Anthony Noto has now bought shares in the open market multiple times in 2026. On May 8th, he bought roughly 15,078 shares at $15.73, about $250,000 of his own money. On May 11th, he came back and bought another 15,545 shares at $1,600 for another $248,000. He now holds nearly 12 million shares directly. He put in roughly $1.5 million of personal capital earlier in the year at higher prices and kept buying as the stock fell. That is not a man who is worried about what investigators are going to find. That is a man who believes the market is giving him a gift at this price and he is taking it with his own money. I have been watching executives for a long time, and that kind of repeated escalating open market buying during maximum negative sentiment is one of the clearest signals I know of. So where does that leave us going into the rest of this week and looking ahead to August 4th earnings? In the near term, I expect the stock to remain range-bound between roughly $14.50 and $17 as the market waits for clarity on two things. First, any regulatory response or continued silence on muddy waters. Every week without an SEC action is a good week. Second, how the federal student loan legislation develops in the House. If that bill passes, I expect a meaningful re-rating for SoFi's student lending business because the numbers on the demand shift are genuinely large. Between now and August 4th, the other thing I'm watching closely is whether the technology platform segment shows early signs of recovery. Management said the large partner integration completes this summer. If they hint at that on any conference appearances before the Q2 report, that could be a meaningful catalyst. My scenarios are straightforward. In a bear case where Muddy Waters gains regulatory traction and the technology platform fails to recover, I see the stock in the $11 to $12 range. That's about 25 to 30% downside from here. In my base case where the overhang fades, the student loan legislation passes, and the technology platform stabilizes in the second half, I see $19 to $21 by year end. In the bull case where all of that happens and crypto monetization improves and the federal student loan tailwind hits full force, I think $25 to $28 is achievable. My probability weighted target is around 20 to 22 over the next 12 months. The bottom line is this. The stock is down 40% year to date. The business just posted its best quarter in history. The CEO is buying his own shares at these prices multiple times. The Muddy Waters allegations remain unconfirmed by any regulator. A major piece of federal legislation could send a wave of new student loan demand directly to SoFi's front door. And the average analyst still sees 35 to 40% upside from current levels. That is not the profile of a broken company. That is the profile of a company in a temporary valuation crisis that the market will eventually resolve when the fundamentals reassert themselves. It always does. I'm rating this a buy at current levels for anyone with a 12-month horizon who sizes the position appropriately and understands the risks. I'll be back with updates as the legislation develops and as we get closer to August 4th. Stay focused, stay disciplined, and don't let the price action make decisions that your analysis shouldn't be making for you. See you next time. Good luck to all of you.